こんにちは。SBI 証券の鈴木でございます。本日はですね、ナスダック市場から、フィリさんをお迎えして、セミナーをお伝えさせていただきたいと思います。普段ですね、聞けないお話とかですね、聞けるかもしれませんので、楽しみにしてください。フィリさんよろしくお願いします。
So let's get into some slides. I like charts, but what I'm going to talk about is a lot about the US economy. Obviously, it's been driving a lot of the factors around the world recently. And really what we're going to talk about is three separate things that kind of run together. So tariffs are a big topic, and then we're going to talk about the markets and three tailwinds for stock markets, which will get us into AI. And let's start with tariffs. Obviously, there's been a lot of tariff news this year. You can see the blue line in this chart. Ever since February, when Trump first started to threaten China and Canada and Mexico with tariffs, we've seen a lot of different tariffs being announced. This is just the country tariffs. And that big bump that you see in the blue line in April is the reciprocal tariffs, which caused the market to sell off a lot. And that's because so many countries were hit with such high tariffs that the economies around the world worried that it would disrupt trade really badly, create a lot of frictions, and actually create a lot of, I guess, extra expenses for companies and tighten their margins. It's interesting when you're talking to companies or the companies that list on Nasdaq, the big question at the time was, why are we getting all these tariffs? And I heard some of the administration talk about what they're trying to do, and it really came down to the deficits. And there's two deficits that they're concerned about. The first is the fiscal deficit in the US. And so if we look at the fiscal deficit in the US, the chart here is showing debt levels versus GDP levels. And over hundreds of years, the level that we're at now at about 100% debt to GDP is pretty close to all-time highs. And the last time we had this was at the end of the Second World War, and pretty quickly the country got the debt levels under control. Now, if you look at that dashed line, the forecast is for the debt levels to keep getting worse in the US and in a lot of countries in the world, but this is really about the US. And the reason that the US debt levels are going to get worse is because if we look at this chart, the government is spending a lot more than it's earning in tax revenues. Even with the tariffs, which is the sort of red squiggly area in the bottom chart there, adding to revenues and broadening the tax base, we still have a big shortfall, over $1 trillion a year. And so the government needs ways to sort of tackle this shortfall, increase revenues, and tariffs are obviously part of this solution. The other deficit that they're concerned about is the trade deficit. And so if we look at the trade deficit in the US, it's a very consumer-driven economy. The reason the US economy was so much stronger than a lot of other countries for the last couple of years was because the consumer was spending so well. But if we look at this, for 30 plus years, the US consumer has been buying more from overseas than the US economy has been able to sell to overseas. And so that's like a structural problem that they really would like to try and tackle. It would help solve some of the other deficit problems. But really, what they're more focused on is what you see in this chart. So if we think back to the 70s, you can see the US economy was about 50% services, 50% goods, and not too many imports. And so the manufacturing sector is that pink sort of vertical bar, was pretty decent sized. As we've rolled forward to where we are now, you can see the amount of goods in the economy has been falling. A lot of them have been coming from overseas, and so the manufacturing sector has shrunk pretty dramatically. And the reason that the government's quite concerned about that is because if we think back to the 70s and we look at the pink line in this chart, you've actually got almost 1 in 4 people working in the manufacturing sector back then. Now you've got less than 1 in 10. And in theory, manufacturing jobs, relatively high skilled, relatively good pay, helps people get into middle class, into upper middle class, and gives people a better standard of living. Those jobs now are gone, and so a lot of people are working in lower paid services jobs, maybe waiting tables where their salaries are a lot lower. It's harder to sort of get a family into the middle class. And so there's a big focus on actually trying to get some more higher paying jobs into America as well. Which of course leads us into tariffs and what's going on with tariffs. When we saw the reciprocal tariffs announced, you could see the fact that this was really a lot about trade deficits in the way the tariffs were structured. So Trump had campaigned on a 10% across the board tariff. That's the yellow box you see in this chart. But when we look at the chart, on the left-hand side of this chart are countries where we have a trade surplus. We, being America, has a trade surplus. And then on the right side of this chart are countries we have a trade deficit with. And so once you got to a 20% trade deficit, you actually started to see basically an extra percentage point of tariff for every percentage point of trade deficit, with countries like Vietnam, way over there on the right-hand side, seeing almost a 50% tariff rate. Obviously, we had a pause for 90 days, a lot of deals were struck, and where we are now is basically where the dots are on this chart. The size of the dots is the amount of trade that the US does with those countries. And I think what's good, I guess, for a regional, Asian regional perspective is a lot of the Asian countries are pretty close to a 15% tariff rate now, which means the countries are all more equal within themselves. So there won't be like trade from China going through Vietnam to get to America, which seemed to happen when we saw Trump's tariffs on China in 2018. So a more equal playing field in Asia. The big question really is who's going to pay for the tariffs. And if we look at what's going on in America right now, you can see people are paying. The tariffs are earning about $30 billion a month, so that's real revenue for the government. That's why that the shortfall in the government deficit has started to close because of tariffs. And you can see the blue color is really where the big uptick is. So the fact that we've broadened tariffs from just China to almost every country in the world means almost every country in the world's imports are actually seeing tariff revenues for the government. Economically, who's really going to pay depends on things called elasticities. And a lot of people are trying to work out, will the consumer pay, will US businesses pay, will foreign businesses pay, or will the supply chain change so that you end up with lower tariffs because you're getting goods from a lower tariff country? What this regression here shows is actually at the moment it looks like the US consumer is paying a lot and the US companies are paying almost half of what's left. So the people that are paying for tariffs, let's take a look at it and see why. One of the things that's happening when we think about whether supply chains are going to shift, so will foreigners really pay for the tariffs? If the costs of making things overseas suddenly becomes uncompetitive, America might be able to build factories and make goods locally at the expense of the countries that are making those goods now. What's interesting looking at this chart is you can see the cost per labor for a lot of countries, especially in the Asian region, is really quite low. And so even if you add on the tariffs, which is the red bar in this chart, a lot of those countries are still going to have a cost advantage. So there's not like there's going to be a wholesale closure of factories that are exporting goods to America right now. Really, the question is, does the exporter reduce their prices, or does the US consumer see their prices go up by the amount of the tariff? Or does the company that's bringing the goods in reduce its margin? One of the things that's really, I guess, concerning is how much is the tariff, if it reduces trade, going to affect GDP for all the different countries. And a lot of the data suggests that really the impact is going to be greater on the North American region. And the reason for that, obviously, there's a land border. There's a lot of supply chain integration between Mexico, Canada, and the US. And so if we look at the dark blue bars in this chart, you can see a huge proportion of both of their economies rely on selling things back to the US, so exporting to the US. So if tariffs do start to reduce demand for goods from Canada and Mexico, that could take a huge amount off their production or the demand for their exports. They would need to find a lot of extra suppliers or extra customers for those goods. One thing that's worth remembering, at the moment, we still have the USMCA agreement, which was the renegotiated NAFTA agreement. So about 2/3 of the goods coming from Mexico and Canada are now still exempt from tariffs. And if you look down the rest of the countries in the list, the impacts are a lot less. And so in terms of trying to replace the demand that might fall in America with other countries, you can see a lot of countries are trying to do deals now with other non-American regions, but the amount of goods that you're going to have to replace and the customers you're going to have to find is much smaller. What's the stock market been saying? Well, the stock market actually seems to say this could hurt America more than it can hurt anywhere else. The red line here is Asia, the gold line is Europe, and ever since February, they've been outperforming the US, which is the blue line. When the reciprocal tariffs were announced, every market sold off, but actually the outperformance held. And so at the moment, the market is saying the tariffs are more likely to be a hindrance to America and American companies than they are to companies around the world. So let's talk about stock markets a little bit more. What are the tailwinds that I see for stocks? And I think there's three. One of them is that interest rates are coming down again in America at last. And one of the reasons for that is the labor market has been softening. There was a lot of talk about the fact that we had a few revisions to data that made the labor market look quite a bit softer, which got the US Fed to stop focusing on inflation and tariffs and start focusing on labor market and the potential of a recession. But actually, I think what this chart's interesting to highlight is the slowdown in the job market, which is the green line, has been happening for years. We've gone from a post-COVID sugar high where there was 2 jobs for every 1 person looking down to a level that's actually much more manageable, closer to 1-to-1 jobs for people looking. But that's been happening over years. So it's not like the labor market suddenly fell because of tariffs. The labor market was normalizing for a long time. And one of the things in this chart that I think is really important for the economy is the red line, which is layoffs, which are still historically very low. And because of that, the consumers and the workers are still pretty comfortable spending their money because they think they're going to have a job in the future and income for a while. But because the labor market's been softening, you can see in this chart here, a lot of the countries around the world, a lot of central banks had been cutting rates. Inflation is basically under control. Unemployment is starting to rise. And so central banks had been working pretty rapidly to get back down to what we'd call a neutral interest rate. An interest rate that doesn't slow the economy down, but also doesn't really need to spur it up yet because the economies themselves are pretty close to Goldilocks, not too hot and not too cold. So the US, which is the blue line here, you can see the pause while the Fed worried that tariffs might cause inflation. We've now seen 2 cuts and we're expecting to see 1 more cut in the market by the end of this year, 3 more cuts going through next year. Gets the US to about a 3% interest rate. That's a lot less than that peak up at 5.5. That's going to be good for especially small cap companies in the US. So what you're looking at in this chart is the proportion of the earnings before interest and tax that was being taken up by interest. And so the higher interest rates that the Fed had created to slow the economy down really hurt mid-cap and especially small-cap companies more than large-cap companies. It was chewing into their margins pretty significantly. So the expectation is lower interest rates will definitely help the smaller companies in the US, and that'll be a tailwind, and it'll broaden out some of the profitability in the market. The other thing that's happening in the US is a lot of tax cuts from the big beautiful bill and some deregulation, making the bureaucracy go away. If we look at the impact of the big beautiful bill, the yellow dot here in the yellow area shows it's meant to be quite expansionary. Companies will have more cash flow, workers will have more cash flow, so we should see a boost to spending. The right side of this chart shows that the boost is distributed among income households not quite equally, so low-income households might not be better off. High-income households should have quite a lot of extra spending capacity. And what's interesting about that is it's actually been the high-income households increasing their spending and holding the spending up in the US recently. And so that should help spending and company revenues persist. The third thing which is driving the market is AI, and AI has gone from something that we thought would become good for companies to something that's actually driving the economy as well. It's real in the sense that it's got real earnings now too. So if we look at the performance, this is almost 2 years of market performance in this chart. The bars are the returns of all these different stock markets. So the Nasdaq 100, which is a tech-heavy basket of 100 companies listed on the Nasdaq. The S&P 500, which includes 400 more US large cap companies, but also a lot of non-tech companies and industrials. And then you look at Asia, you look at Europe, and you look at US small cap. And you see that the Nasdaq 100 has outperformed all of those indexes, not just with the bar, but also with the dot. And the dot is earnings. So the earnings of the companies in the Nasdaq 100 have been growing faster than the earnings around the rest of the world. And really the reason why is because of AI. It's because of calibrating the large language models. It's building out the data centers to actually run AI. It's real spending and real revenues to the hyperscalers, which you can see in here, are spending upward of $300 billion a year and expected to keep increasing to create this infrastructure that will let AI happen. What's interesting right now, people are talking about the AI stock prices looking a little bit like the tech bubble. And so this chart shows the tech bubble sort of in the middle left there, with the large cap companies in the dark blue in the tech bubble getting up to a price earnings multiple over 50. And what happened in the 90s, a lot of the companies realized that didn't realize customers, didn't realize revenues, and so eventually the market sort of re-rated because there just wasn't profits coming through. This time is different in one way in particular, which is that there are real revenues coming through from a build out of the AI infrastructure. And what's happened is, if you look at the dark blue line, the PE multiples have actually been coming down because the earnings are now starting to grow faster than the prices have been going up. So rather than these, even though the stocks are still at all-time high prices, the valuations are actually starting to get less expensive, closer to more normal and middle of the range levels in the US. The other thing AI is doing in the US is actually starting to drive the economy. And so if we look at a chart like this, it sort of shows pretty clearly the amount of spending building the data centers and building out some of the infrastructure for the compute is actually starting to compare with office construction. So since we came out of COVID, a lot less demand for offices. Office construction's been falling, but the amount of people employed in the construction sector hasn't really fallen because they're all moving into constructing data centers. So that's real jobs, real data center construction, driving the real economy, as well as just the theoretical AI spending. And one of the questions right now is the AI spending too high? And that's an interesting question because $300–400 billion a year is a lot. People have been talking about AI as a change to the infrastructure of the economy, to the way that we will make things in the future, and likening to things like the internet in the 90s, and even railroads in the 1800s. And so the blue bars here show the scale of spending as a percentage of GDP. The economy spent a lot more on railroads than they have spent on the internet or on AI so far. And that kind of puts things in perspective. I mean, railroads made a massive difference to domestic trade in the world in all sorts of different countries. But in America, you could suddenly export things from one state to another before they would spoil. And so railroads made trade go up a lot. The internet created connectivity. It allowed us to do things like Netflix, streaming music, and using our phones and maps to work out where we need to go. So the AI complex is expected to create productivity gains as well as it goes forward. In terms of how much those productivity gains might be worth, this chart's interesting because you can see the internet bubble in the first blue zone. And actually the build out of all the internet happened in the 90s, but the productivity spike or the hump in that black line is mostly in the noughties from 2000 to 2010. And you can see productivity was about 2 percentage points higher for almost 10 years. So mathematically, that's about 20% increase in productivity in GDP. If we can do something like that, we can actually add probably $6 trillion to the US economy. So it kind of puts in perspective the $300 billion that's being spent per year. One thing we're seeing is international investors hear this story, they want to make sure that they're exposed to it as well. And so when you want to buy the AI story, there are some companies in the Asian region that are really good at doing chips. But in terms of the sort of relative spend on hyperscaling and data centers and chip manufacturing right now, a lot of it is actually happening in the US. And so what we're seeing, especially at Nasdaq, where we have a lot of the Mag 7 and the AI and tech-focused companies listed on the Nasdaq, is investors in Asia really want to buy the companies that are actually mostly US listed because of this trend. And so this is from an academic study looking at what I would call overnight trading, which is trading in the daytime in Asia. And a lot of the trading in US stocks in the daytime in Asia is coming from Asians trading while they're awake, from Korea and other countries around the world. So definitely a big pickup in overnight trade, what I would call overnight trading. The interesting question is, what are investors here buying when they're trading US stocks overnight? And you can see the blue bars there are stocks like Tesla and Nvidia. It's a lot of the Mag 7. It's the things that are pretty popular and large cap stocks in this AI complex. And then the orange colors are actually ETFs. And if you sort of look through the list of what these ETFs are, it's S&P 500, it's Nasdaq 100. So it's that US large cap complex that had the stronger earnings, that's had the stronger performance. This is the top 15 tickers that trade overnight. It makes up more than 50% of all of the notional that trades. And I just want to finish with, I guess, a positive news story for this region in Asia, because as much as I've been talking about how the Nasdaq 100 and the S&P 500 have this AI exposure and they've been doing really well, and there's earnings underneath the companies that are driving the fundamentals, what's been interesting so far this year is actually Asia and international equities are starting to outperform even the Nasdaq 100. So we are really starting to see a broadening out of investor appetite for equities around the world.
ここからの時間はですね、日本株の方の、セミナーをさせていただきたいと思います。本日のテーマはですね、日経平均5万円、その背景と今後の見通しということでですね、一つのポイントから、お伝えしたいと思います。まず最初のページですけれども、現在ですね、日経平均は史上最高値をですね、更新しております。こちらのグラフにもあります通り、その理由はですね、いっぱい挙げられますけれども、一つは高市政権の発足と政策期待ということで、また日本維新の会と連立が成立したことで、大阪首都構想などがですね、大阪副首都構想などがですね、国策として動き始めた。それからですね、アメリカの金融緩和方向というのが日本にも影響しております。3番目としまして、米中関係改善への期待。資料の方ですね、作成時10月ですので、若干表現がですね、古くなっている部分もあるんですけれども、米中関係改善に対する期待というのも出ております。それから4番目として、日銀の追加利上げがなかなか進まないということで、10月の時点でですね、これ見送りかということだったんですけど、実際見送られて、高市政権が成立したこともありですね、なかなか利上げしそうでしないという状況が続いております。あと、5番目としまして、外為市場で円安基調が続いていること。それからですね、今日、福さんお越しのナスダックの企業も含めて、米国企業の高決算が続いていること、それから日経平均の予想1株利益がですね、過去最高水準に達していると。これは後で説明しますが、10月29日にですね、2687円まで上昇しております。さて、次のページなんですけれども、日本株はじゃあ高値更新した5万円高いですよねっていうですね、ご意見出そうなんですけれども、89年、以来のですね、長いチャートでですね、最初の89年12月末を1として、イギリスとアメリカと日本の株価がどうなっているかというと、日本というのはですね、89年末ですから平成バブルの天井から計算しているんですけれども、38,915 円から、今5万2000円で計算しても、これ 33% しか上がってないんですね。それに対してですね、もうこの縮尺にもあります通り、アメリカですとですね、20倍近くになってますし、イギリスでもですね、数倍にはなっているということで、今どこが正常かなっていう疑問はとりあえず置いてですね、次のページを見ていただき、この背景にあるものはですね、こういうことだと思うんですね。結局ですね、日本の低迷を、長く、ですね、導いてきたのはやはりデフレではないかなというふうに思います。このグレーがかっているところはですね、消費者物価がですね、前年比でゼロ以下のところを示しています。時々大きくですね、物価がですね、この下に行っているところですね、これは明確に理由がありまして、一番左側は、この金融危機、それから2番目は真ん中辺ですね、これリーマンショック、そして一番右がコロナというふうになってますけれども、いずれにしろですね、日本はですね、長いですね、このデフレの時代がですね、続いてきたというのが、先ほどのグラフにあるですね、日本の株価が低迷してきた大きな理由の一つじゃないかと思うんですね。で、この89年末からですね、2025年の9月末まででですね、各月の消費者物価の前年同月比をもう単純平均取るとですね、日本は 0.6% しかないんですね。それに対してイギリスがプラス 2.4%、アメリカがプラス 2.6% で、よく 2% のですね、2% 程度の金利がすみません、物価がですね、物価上昇が好ましいみたいな話は聞きますけれども、やはりこの 2、3% のですね、適度なですね、インフレが平均して、続いていること、アメリカで言えば、そこに技術革新ですとかですね、世界経済でのリーダーシップというものがあって株価を上昇に導いたということだと思うんですね。で、日本の場合はですね、やはり、長く物価が低迷したというのが一つ大きな理由だと思います。で、皆さんですね、日経平均というのは例えば今5万2000円みたいな言い方しますけれども、これ実は不正確ですよね。
日経平均は例えば5万2000円ですけれども、1株あたり円なんですね。例えば原油でいけば1バーレルあたり、ドルという。で、この原油でいけば1バーレルとドルの交換レート。ですから日経平均というのは株と円との交換レートという読み方ができると思うんですね。で、インフレというのは、いつも、私のセミナーでは言ってるんですけど、物価が上がることと別の言い方をするとお金の価値が下がることなんですね。したがって円が下がるということは対面にあるですね、この株価が上がりやすいということを意味するんですね。で、実際にはですね、この適度なインフレが続くことによってですね、この企業や家計もですね、この資産が増えやすくなるということになりますので、これ経済的にはですね、実質債務負担が減るという形になりまして、企業業績にもプラスになっているということだと思います。物価が高いというと悪者扱いされがちなんですが、マーケットを見るときはですね、一つこの別の角度から見ておく必要があると思いますね。で、次のページは、結局ですね、日本株高の背景にはですね、ようやく物価がですね、デフレから立ち直ってですね、この右の方ですね、特にこの赤い線で囲ったところはですね、日経平均が高くなってきたところですけれども、ようやくこの物価がですね、2、3% のですね、このラインにこう入ってきたことを意味しています。もちろんですね、生活のことを考えるとですね、ハイパーインフレみたいなですね、極端なインフレはですね、逆効果になりますけれども、やはり、この適度のインフレというのがですね、安定的に推移することが一つ株高の条件なんではないのかなと。今その条件がですね、ようやく揃ってきたのかなというふうに思います。そうした適度なインフレも背景とあってですね、もう一つ株価が5万円だ、バブルかどうかという論議出てきそうですけれども、実は長い目で見れば日経平均というのはですね、この日本株のですね、日本株の、企業業績の方向感を示す一株利益、EPS ですね、これの上昇とともに日経平均も上がってきたということですね。そして日経平均の初の5万円超えというのが話題になりましたけれども、我々は日経平均の予想した株利益が2600円を超えてきて過去最高水準になったというのも注目しています。そして先日は2700円にあと一歩手前というところまで来たということですね。で、おそらくですね、当面のですね、株価を見る上でのポイントは、じゃあ日経平均が2700円の一株利益に乗ってくるからとか。で、これが来年ですね、増益率10% になると言われてますけれども、 10% で3000円というふうになってくるかどうか。また今 PR が19倍ぐらいまで買われてますけれども、20倍超えてきた時ですね、やはり節目になりますので、20倍というのをマーケットがどう見ていくのかというのがですね、今後ポイントになるんではないのかなと思います。で、足元はですね、次のスライドにもあります通り、リビジョンインデックスといいましてですね、この情報修正と下方修正のですね、情報修正の相対的な比率が高いと、このリビジョンインデックスが上に行くんですけれども、最近はですね、このリビジョンインデックスがですね、上昇してきたことで株価上昇に弾みがついているということですね。ただこれ、ちょっとチャートを意地悪に見るとですね、今ちょうどリビジョンインデックスがこれ 0.2 ぐらいまで戻ってきてるんですけれども、 0.2 からなかなか上に行きにくい指数であることもこのグラフは示しています。したがってですね、情報修正ラッシュがですね、いいとこまで来たんじゃないかと意地悪に見ている方もいるということで、これは昨今のですね、少し株価の乱高下にもつながっている可能性ありますので、ここの辺は注意していただきたいなと。ただ基本的には企業業績は、右肩上がりに上がってきたタイミングであるということをお伝えしたいと思います。私の方の説明は以上で終わらせていただきます。ありがとうございました。それではですね、続いて、Q&A のセッションの方に行かさせていただきたいと思います。
それでは、質問の方をですね、読まさせていただきたいと思います。AI の動向なんですが、どの企業が何をしているのか、勝者と敗者は誰なのかという投資家からの質問なんですが、いかがでしょうか。
Yeah, I mean, I think having lived through the tech bubble, comparing that to where we are now, I think we're starting to see a broadening out of the companies that are winners from the AI threads. So it's not just the Mag 7 anymore. It's not just the hyperscalers. We had the Batman. You're starting to see other chip makers sort of picking up a bid because a lot of chips are going to be needed. What's going to be interesting, I think, in the next 5 or 6 years is to see what companies get to benefit from the AI as a technology as well. So when you think about what happened with the tech bubble, building out websites, building out connectivity was what created the productivity gains, but the companies like Netflix that were able to use the bandwidth that was created for the internet are the companies that were winners. Interestingly, we had a period in the 90s where we went from tech to telecom and media as well. Obviously, Netflix is a media stock, so it's been a beneficiary, but the telecoms, despite the fact that they built all of this infrastructure that are the rails for the internet, didn't turn out to be the trillion-dollar companies like some of the Googles and Amazons of the world that benefited from the internet. So it's going to be really interesting in 5 years to see where AI has gone from. Right now, it's very focused on building the data centers and building the chips to do the LLM models. What happens when we start to deploy AI into other people's products, into workflows to make companies more productive, increase their margins, to create new products that we don't do right now, and that's all of a sudden change the way we work and the way we live. Some companies are going to come out of nowhere and be really, successful, and I guess some other companies, if they're not dynamic enough, could get left behind.
ありがとうございます。日本ではですね、結構、もうすでに物色されてますけれども、電線株ですね。ちょっと古い言い方しますけど、あと近年はですね、SIR というですね、情報サービスの会社もですね、非常に活躍してますし、最近ではですね、一部、個別銘柄なかなか言いにくいんですけれども、そのデータセンターの設備投資で、利益を上げている会社というのも結構多いですね。よく見ると、電気工事の会社などもですね、買われてたり、さらにはですね、この建設株などもですね、データセンターの、この投資で恩恵を受けている。結構業種的な広がりを見せていて、今後が期待されているかなと思いますね。はい。それでは、次の質問に行きたいと思います。ETF の投資アイデアについてなんですけれども、市場の変動が続く中、この ETF に関してどのような投資機会があると思われますか？
Yeah, I mean, from an American perspective, especially with Asians buying American companies already, there's more than 4,000 ETFs in the US these days. So you don't have to just buy a total market index. You don't have to just buy the S&P 500. You can actually tailor an exposure in a lot of different ways. There's active ETFs now. You can also get more focused ETFs than just even the Nasdaq 100, which is obviously 50% of the Nasdaq 100 roughly is your Mag 7 stocks, but you can get more focused like Philly Semiconductor Index ETFs. You could get US tech sector ETFs. And so you can even, if you're thinking about the utilities or you think about the energy that the data centers are going to use, you can buy ETFs that actually have more customized exposure to those specific themes, as well as just buying the Nasdaq 100 because it has all the AI in it.
本日はですね、本当貴重な話をですね、たくさんいただきまして、そして、最後ですね、Q&A にもお答えいただきまして、フィルさん、どうもありがとうございました。またよろしくお願いします。
Thanks for having me. I always love being here in Japan.